Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Sonali Basak, in for Matt Miller today. Katie, I hear we're going to talk about bonds. We're going to talk about ETFs a little bit.
We're bringing fixed income to the ETF wrapper. It's going to be fantastic.
I'm excited to be the bond girls today. Let's get to the biggest stories right now in the more than $10 trillion global ETF industry, because BlackRock and Vanguard, they've always been the big dogs of the ETF world, but some other names are starting to gain some ground.
Plus, we're going to speak to the firm behind the world's first buffer ETFs. We're going to discuss one fund just launched with 100% downside protection.
Here, we're also going to have some fun on this Monday. We're going to take a look at the Vice ETF. Holds gaming, alcohol, cannabis-type companies. You were going to wish it were Friday night.
There we go. But it's Monday, which means that Eric Balchunas from Bloomberg Intelligence here with us now, taking a look at the flows. Eric, what do you got?
Thank you, Katie. Sonali. The flows are interesting. The trend that we've been seeing from treasuries into U.S. equities is definitely alive and well. But look at the top, IJH. Most people don't know that one. That is a mid-cap ETF. And then go right down to number 9, RSP. That's an equal weighted. I think those are two peas in a pod. This is a way to buy the market, but without that mega cap exposure that's been carrying the market. A lot of people are interested in sort of selling off some of that, but yet they want equities. You also got some general equity ETFs on here. XLE also, that's a bid, that's interesting. Energy hasn't seen a bid in a while. Let's look at the outflows. And as I said earlier, you're going to see a lot of treasuries on here. Europe at the top, though. Europe really not having a good summer. But you go down here, you see GLD, TLH, and then you've got down there SHV, GOVT. Those used to be leading the inflows for the first part of the year. So again, let's take this theme of what we call the FOMO drought ending and look at that. This is U.S. equity ETFs minus U.S. fixed income ETFs. And again, fixed income had taken in more. Equities, this is what we call the FOMO drought. Equities were outperforming, but nobody cared. Why? Because you can get a pretty good yield in bond ETFs and cash. But as equities start outperforming and putting up numbers double digits, 20%, 30%, people couldn't take it. They're like, 4% isn't going to cut it. I want to get into equities. And bam, U.S. equities have now passed fixed income inflows where they usually are. And that's a big trend we're seeing all year. So, Sonali, Katie, people definitely want equities, although you can see some of them are now wanting it without the mega cap.
Well, we're going to discuss whether this is people want equities, they don't want fixed income, or they just want equities more than fixed income. We have the perfect guest joining our conversation right now, Joanna Gallegos. She is the co-founder of BondBloxx, joining us on set. It's great to see you again.
Nice to see you guys.
Let's talk about some of those trends, because we've been waiting for that line to flip on that chart for a while now. It finally has. When it comes to fixed income and your fixed income focused lineup, are you seeing appetite shift around?
Yes, we are. And so the way we came about the fixed income opportunity in 2022 and 2023 is to launch suites of products that cut up the market and the exposures of fixed income. So for exactly these markets, you're able to move around in the opportunities in fixed income. And so one of the interesting trades that we're starting to see, and I think it's reflective of exactly what Eric was talking about, is that yes, there are people that have been using the short end of the curve for the the yields that are in the 6-month and 1-year space. It's a very nice risk-free, duration-free space to play in. But there's been a shift in July where flows into Treasury products have slowed down dramatically. And what you are seeing, though, is you're seeing they're moving into different products across the curve. So we're seeing interest in the middle of the curve, which could be indicative that people are closer to absorbing that this is the end of the rate hike cycle. And next year, the market's anticipating rate declines. And that middle of the curve, 2-year, is a great way to play that right now.
It's amazing that we're talking so much about Treasury. They're kind of the most volatile and most talked about part of the market, about $100 billion in sales coming in the next couple weeks, really. How do you think about the investor inclination to take on more duration than that 2-year as you're talking about?
Yeah, so I think it's a spectrum of how people's views are developing. So obviously, if you feel that there is something coming, that the market is going to really see a downturn, you would probably trade much further out on the curve in treasuries towards 10 and 20-year. But I think what people are really responding to, again, is that middle of the curve where there's a line of sight to 2024 and the end of 2023. At BondBloxx, we don't see a recession coming in 2023. Yet the yields are still at historic highs, and you're benefiting from a lot of categories that can compete with some of these equity returns.
So I bring up one of your ETFs probably like every 4th show. It's XCCC.
Yes.
It's got the most junk in it by far.
Yep.
And it's all triple Cs. The yield on this, last I checked, is 13%. That is pretty juicy, considering long-dated treasuries and cash is about 4%, and even HYG is 8%. Yet no bites. When you go out and talk to people about this thing, what are they worried about? Like, why not just put 1 or 2% in this, given you have so much yield?
It's exactly the trade we talk to investors about all the time. I think many people missed this trade because they expected a lot of downturn sooner in 2023 and obviously in 2022. The yields provide an amazing cushion for future volatility if there is some, but the resiliency and the fundamentals in credit, we were talking about this last week, if more than anything else, I want investors to start paying attention to credit because there's a lot of dispersion and there's a lot of quality, even as far as double B in high yield. If you want issuers with the strongest balance sheets and the lowest default rate in high yield, you should look at XBB. There's just so much dispersion and difference in high yield. You shouldn't trade it as a block broad thing anymore.
Well, triple C's in particular,
Sure.
There's a lot of worries about default risk in that part of the market, and you are seeing defaults start to tick higher, a lot of things trading at distress. How are you baking in that concern?
So I think one of the things that's nice about ETF exposure, and I'm really glad BondBloxx has brought such precision to fixed income, so you can start looking at this, is that's a very big portfolio of diversified issuers and issues in the portfolio. There's over 200 bonds in that portfolio. So you're not having to select, a specific exposure. You're getting a part of the market that is diversified in terms of getting to triple C's. Again, the default rates for all of high yield and for triple C's are not above normal averages. So this distress did not develop, to Eric's point. And clients are asking and telling us they were looking for these widening in spreads and they were waiting for that moment before they got in. And I think that not looking at credit and not, considering, even just looking at our website, you can start to see these holdings, you can start to see the difference in yields. We just encourage everybody to take a look.
And to Eric's point, in terms of XCCC, I mean, that's a broader high yield story. High yield ETFs are actually sitting on net outflows for the year, even though they're doing pretty well. I think we're going to get into that in the next block. But I want to talk specifically, when I look at your lineup, I see XHLF and X1 as still sitting on pretty significant inflows year to date, and those accelerating. Of course, that's 6 months target duration and 1 year target duration. And when you talk to clients, investors in those funds, what's the idea behind that? How does that tie into what the Fed is expected to do?
So duration is the key word there. We saw in the marketplace that this space had not been updated and duration varied widely across the existing treasury funds and ETFs. So we wanted to offer investors tools that gave them the specific exposure. So as these risks were developing, so now we're at the top of the Fed rate hiking cycle. If you're going to start coming down, you want to have precise exposure. So I think that that's an important thing we're reminding clients that our products do very differently. Is if you want 1 year duration, 2 year duration, you get that in our product. Existing products have a variation in that. And then cost. With these rates, we also thought that the cost should be updated for the fixed income space. The products are 15 years old. So we want to make sure that investors can keep as much yield as possible and benefit from this cycle.
Speaking of precision, so it seems like precision has worked in duration, right? And it's also worked with credit. But you've gotten precise in sectors. You have a media and tech bond ETF, a financial and REIT sector ETF. Just no bites there. It's interesting. Why don't people want that? I thought there'd be thematic fixed income ETFs at this point, but if the sector ones aren't getting bites, maybe there's no hope for themes in bonds either.
I say there's never a bad time to launch an ETF, and you need room for an ETF to take hold in people's portfolios. So the best thing about BondBloxx is that those products exist, and we're talking about them. I'm not concerned at all about the bites. I just want to tell people that there's a dispersion between the top performing sector and the lowest performing sector year to date of 500 basis points. I want to educate people that BondBloxx is updating the ETF space, so now you can trade with all these developing views that we've seen in 2022 and 2023. So as a veteran in how products grow, there's nothing to see here except to make sure you're considering things like cyclicals and energy and how different that story is compared to financials and telecom.
Right, that's a good place to leave it, Joanna. It's great to see you again. That is Joanna Gallegos of BondBloxx.
Thank you.
Coming up on this program, taking on the big two, how other issuers are encroaching on the likes of BlackRock and Vanguard. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF world. We talk about a flip side to that junk bond rally that we've seen. We're talking about HYG and JNK here. If you look at short interest data from S3 Partners, it's really increased dramatically over the past month. We're talking about an 18% jump here. All told, you look at the notional short interest, it's currently above $7 billion on these two ETFs. So we'll see how that plays out. But let's go from junk bonds over to muni bonds, sort of the spiritual opposite, if you will. We're taking a look at quarterly muni ETF inflows. Actually, so far this year, muni ETFs have only taken in about less than $4 billion. You compare that to a year ago at this time, that number was closer to $14-15 billion. So a big flip in appetite there. We'll see if that changes as we head into the second half of 2023. But as we approach year end, I wanted to check in on the league tables because we know that BlackRock and Vanguard absolutely dominate this industry, and they still do. But if you take a look at BlackRock's share of overall ETF inflows, it's currently at about 15% year to date. That is the lowest share since 1999. And then you take a look at number 3, JP Morgan, taking in about 9% of inflows. That is their highest share ever, Sonali, and it just shows that we have some issuers trying to take on the big two.
All about that active management. We're going to talk more about this with James Seyffert of Bloomberg Intelligence. Thank you for joining us because, you know, there are a lot of upstarts entering this world. Morgan Stanley, TCW, the newest with an acquisition coming in here with engine number one's ETF business. What are the winners looking like this year? Is it all about active management? What are they offering?
So there's been a dichotomy in flows, which you kind of hinted at and what Katie just spoke about. Through June, active managers were dominating. They make, specifically on the equity side, right? So active management on the equity side makes about 5% of the assets in the ETFs, but they accounted for about 60% of the flows. That has flipped a bit. Now it's down to 15% of the flows, but again, it's still way outpacing the passive counterparts. So a lot of these new entrants, or in the case of Morgan Stanley, they launched what is now iShares and ended up selling it off to Barclays, which BlackRock then bought. So they're back, essentially. But at the end of the day, it's a lot of active managers coming in and realizing that they can't avoid the ETF marketplace. There was a lot of hemming and hawing from these legacy asset managers trying to figure out ways they can avoid the ETF marketplace because it's not as high margin as some other areas. But it looks like everyone's coming around to the point that you kind of can't avoid it at this point.
You can only resist the siren song of ETFs. For so long. Let's talk about how the likes of BlackRock and Vanguard respond, because in writing that story, it's striking that BlackRock has over 400 U.S. listed ETFs. Just 24 of them are active. Do you see a BlackRock, for example, pushing more into the active industry or sticking with their bread and butter?
I think they can easily do both, right? They are launching active ETFs, and they're launching them not under the iShares name. There's a few ETFs out there that are just literally called BlackRock ETFs. They don't have the iShares branding. So they can obviously do the active side of things. One of the big things we're seeing in this is really the things doing extremely well. There's like a dichotomy in the active side of flows, right? It's either you're pretty broad and relatively cheap active ETFs, or you're going concentrated and going for high-flying stuff, and you can charge a little bit more on those things. But the stuff in the middle is kind of getting left out, and BlackRock knows the ETF ecosystem. I wouldn't count them out just yet. And as I said, since June, things have really started changing. It's like two separate ecosystems going on. You have through the beginning of June and since then, and it goes back to kind of the FOMO drought that Eric's been speaking about. We're seeing a little bit of a shifting in those trends.
Okay, so BlackRock with the potential to get more active, new players coming into the market. How much fee pressure would this cause? You think of like a TCW where they only have actively managed products. And to get into the ETF industry, does that bring down the pricing really meaningfully for the industry?
So for the ETF industry, it might bring it up actually, because these active managers can come in with things that theoretically you should be able to charge more money for. The problem is, like, some of these managers are used to charging 80, 90, 100 bips for things that are really more in the camp of what I talked about earlier, more diversified, not super active, not super concentrated. So these managers are going to have to figure out ways, they're going to have to bring down fees, because you basically, when you come to the ETF marketplace, you have to play on the ETF's marketplace rules. And for the most part, if you're cheap, you do well. And obviously, if there's some high-flying names out there, high-flying ETFs, they'll get interest. But for the most part, they're going to have to come down and probably bring down their fees.
And if we really boil this conversation down, I mean, we're still talking about Vanguard and BlackRock, trillions of dollars in their ETF. So even as we see the flow picture start to get a little bit challenged for them in terms of total assets, they're in their own league. And when you think about sort of the rat race at the top, the BlackRock versus Vanguard rat race, if you will, when does BlackRock overtake Vanguard? What is the current Bloomberg intelligence view, or rather Vanguard overtake BlackRock?
Yeah, so we've swayed on this, but it's going to happen in the next 3-ish years, we think. But that's assuming that the trend continues. Obviously, the first 6 months of this year, as I keep saying, has completely changed that. Vanguard did decently well. BlackRock obviously didn't, lowest flow percentage of the year. But Eric highlighted a bunch of names in the flow charts to start the show today that are doing very well, that are BlackRock funds. That said, Vanguard is definitely on track to pass BlackRock as the largest ETF issuer in the U.S. at some point within the next three-ish years, I think.
Well, I know you're going to be following it closely. That is James Seyfarth of Bloomberg Intelligence. Thank you so much. Still ahead, we're going to drill down into the Innovator Equity Defined Protection ETF. We're going to do that with Graham Day. He is the CIO of Innovator ETF. That's coming up next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld along with Sonali Basak.
And Eric Balchunas from Bloomberg Intelligence is back with us now for today's drill down, where we focus on just one ETF. Eric.
Today we're going to look at TJUL, which is it's a mouthful, I got to read it, the Innovator Equity Defined Protection ETF, 2 years to July 2025. This is an ETF you're supposed to sort of ideally buy when it comes out, and then for the next 2 years, 100% downside protection. You will lose no money according to the ETF. We'll talk about that in a minute. 79 basis points is how much it costs. What do you give up here? You give up some upside. It only promises you up to 16% return on the S&P over those 2 years, and anything above that you don't get. Let's look at what it holds. You're going to see some options in here, but not a lot. It's pretty simple. The key one is this put option on the S&P 500 for 450, which is about what it's trading at right now. That is the downside protection part. Let's look at the returns. Again, it's so new, this really isn't that important of a screen, but I think over time, this is the S&P is probably going to be what this is going to be looked at against. But you can see how it's a lot less volatile than the S&P. So, Katie, Sonali, look, it's upside with no downside. It's a pretty compelling pitch. It'd be interesting to see if we dig into this ETF, what it actually does.
Eric, thank you. And I'm thrilled to say joining us to talk about this ETF is Graham Day. He is the CIO over at Innovator ETFs, the pioneer behind the world's first buffer ETFs. And Graham, you take a look at TJUL, and it's sort of a buffer ETF to an extreme. And I want to talk about what you give up here, because as I understand it, so the cap on potential gains after fees is about 15%. So does that mean if the fund is up 12%, and that's when I buy it, that it'll only ever return 3% more?
Katie, you're right, but like Eric said, what these products aim to deliver is one-to-one upside to the S&P 500 ETF over a 2-year outcome period to that 16.6% cap, but with a 100% buffer in place. And if you look at the markets today, we're seeing a tremendous amount of investors who are unwilling to put any of their capital at risk. There are record amounts of cash on the sidelines. JP Morgan just said that 25 to 30% of their clients' investable assets are sitting on the sidelines. This is a way to get clients off the sidelines into the equity market, but maintain that capital preservation mindset.
So what happens when times are really good? I mean, to Katie's point here, when things are tough and you're worried about the downside, it makes sense to protect that downside. But if you can give up gains above that in the regular way market, you think about how much the NASDAQ is up this year, for example. Do you get as much interest? And what's the pitch you're going to have to make in those scenarios?
You know, the beauty of these products is right now, with a 16.6% cap over 2 years, that's on average what the S&P 500 has delivered long-term, around 8-9% a year. But these products aren't meant to replace a core equity position. These are for investors that have cash on the sidelines. These are for investors that are maybe using insurance or bank products that do similar, have a similar objective. They give you some of that equity upside, but they have a 100% buffer in place. That's the market that we're really going after, a market that has been dominated by those two industries. But now putting this in the ETF wrapper, lower cost, tax efficiency, no surrender charges. Some of the problems advisors have had with those wrappers in the past, the ETF wrapper is a huge advantage to advisors and their end clients.
So who is this meant for? Who do you see as the ideal audience for this ETF?
You know, it depends on the risk tolerance. It depends on the objectives that advisors have for their clients. But what we would largely say is the objective of this is to be an alternative to the market-linked CDs, to the insurance products that give you some of that equity upside with 100% buffer, but give it in the ETF wrapper. And I think one of the things that we really hammer is the tax efficiency of the ETF. You look at those other structures that are not as tax efficient. It's a big difference when you're able to defer gains to when the end advisor or client wants to sell. So that's a huge advantage that investors can get with the ETF.
All right, Graham, got to leave it there. Really appreciate it. That is Graham Day of Innovator. Before we go, here's a special look at another ETF with some bad habits.
The Advisor Shares Vice ETF goes by the ticker VICE, and as the name and ticker imply, it focuses on Vice industries. We're talking about alcohol, gaming, tobacco, food, and cannabis. The fund is actively managed, which means the team behind Vice looks to strike a perfect combination, mixing predictable returns from alcohol and tobacco names who provide dividends with companies who provide growth potential. Most of Vice's holdings must get at least half their revenue from either tobacco and alcohol, food and beverages, or gaming. This is the U.S.-centric fund with 2/3 of its 30-odd holdings based in the country. Top names include the Vector Group, Dave & Buster, Boyd Gaming, MGM Resorts, Turning Point Brands, and LVMH. As such, investors get exposure to beverages, agriculture, retail, and lodging. In other words, the consumer staples and discretionary sectors. Only legal activities are included in the fund. Vice has about $10 million in assets with its returns trailing the S&P 500 this year. But it gets a green light in the Bloomberg Intelligence traffic light system with one warning due to it being actively managed.
That does it for ETF IQ. This is Bloomberg.